Money Show.
Personal Finance with Warren Ingram.
Personal Finance, Warren Ingram, Director at Galileo Capital and Executive Director there. He is a financial advisor in his own right. Does it always make sense to phase in your money into the stock market? Why don't you just keep the money in cash and then markets stabilize and then somebody rings a bell and then you buy shares and you get rich and life is good and easy. This thing of phasing money into stock markets, and I've confessed this before, Warren, that last year, because I'm smarter than everyone else in the world, I looked at my retirement annuity money and I went, you know what? Markets invariably end up going up in March, April and May. That's what usually happens. I'm not going to waste time phasing my pitiful little contributions to my retirement annuity into the market. You know what I'm going to do? I'm going to pop it all in at once. What happened a month later? But the stock market fell on its face. And had I phased my money in, I would have bought a whole bunch of shares for less and be better off today. So what did I do this year? But I phased in my money. And so what happened to stock markets from the 1st to the 31st of March? They went up. What did they do from the 31st of March to the 30th of April? They went up. What did they do from the 30th of April to the end of May? They went up. So you're damned if you do and you're damned if you don't is my point.
I'm not sure that you are. I mean, I think you're talking about the first, let's say, 10 meters of 10,000 meter run. And last year you started by running backwards, so you were running away from your goal, and this year you've started running towards your goal, and maybe you haven't started at flat out pace, but you've certainly started in the right direction. And you've got some energy banked, and you've got that. You can deploy that energy over time, and as things go, you'll get closer and closer to your goal. So I think your strategy this year was good, and I think the difficulty with phasing in always is it's so obvious in hindsight, and I think that's what we're talking about now. Is we're looking at the markets having risen very strongly, and then saying, well, that was silly. We should have just invested our money as lump sums and ridden out the losses. The problem is that falling markets aren't as kind to us when we get the decision wrong the other way. In other words, my favorite example of all time will be investing your money on the 1st of January in the year 2000. And the world is going incredibly well. Technology's changing the way everything's going to work. Everything, the economies are booming, everything is just going fantastically. And all of a sudden, the technology bubble bursts in America, especially actually in those days, it was really the internet bubble, not so much a broader technology bubble. And the stock market did absolutely nothing for people over a 10-year period. And that was only for people investing a lump sum at once. Anybody else who'd been phasing in for a few months before and a few months thereafter, or had started phasing in the middle of all of that noise and the disaster that was going on, they made money over that last decade. So I think understanding phasing in is to say that you're not going to aim for the very best returns you can possibly get. What you're trying to do is follow rule one from Mr. Warren Buffett, which is don't lose money. And that's really the starting point of any sensible investment strategy. Is if you can make sure that you can sort of say, I've got the 10,000 meter goal, and what I need to do today is make sure I start running in the right direction and keep going, and at some point I'll achieve my goal. Then you're doing the right thing. But to start off by running in the wrong direction is really that's the most destructive thing you can do. I think in an environment. Please go ahead.
No. You finish your point, and then I'll make my better point.
So in an environment that we're in now, where the world is so volatile and there is so much news going on everywhere, I'm not even talking about, just in South Africa. We look at, the deep fear that a lot of people have got about, the Chinese government and Chinese regulators and the way they're, perceived to be attacking big companies and especially technology businesses in China. We look at the fears of inflation in America and, what's the Federal Reserve going to do there? And around the world, COVID's coming back, and now there are discussions of fourth waves and fifth waves, etc. And the world's in a really kind of uncertain place. And so investors who are, wondering now if they should just wait, sit on the sidelines, wait for things to get better, I think they're the ones that are really doing themselves a disservice, because the world can be incredibly uncertain for many years. That doesn't mean stock markets don't carry on rising. And that's always my great fear in a time like this, is that people just, they allow, I'm agreeing, it's logical that, that we should be concerned. It's a rational concern now. But they allow that concern to overwhelm the other part of the logic, which is markets tend to be volatile, and that's the time they give you great opportunities to buy investments. And if you're sitting on the sidelines, you're missing out on all of those opportunities. And if you wait for things to get better, you're only buying investments when they're expensive already. And so you're absolutely hammering your ability to get any kind of return over time.
This is the point that Julia makes, either directly or indirectly, over her 14 years of experience that she shared with us for the last 10. And the fact is that she has added regularly, up until about 4 or 5 years ago, to her investments each and every single month, contributing over a period of time about a third of her salary over a 10-year period. And whether markets were going up or markets were going down, Julia learned that you simply put your allocation into your investment portfolio. Some days you pay a bit too much for your assets, and other days you pay far too little for your assets. But over time, you build an investment portfolio by leaving money in a bank account, in a current account, and waiting for opportunity means that you're always second guessing yourself. You never, ever are going to get it right, even half the time. And so slow and steady wins the race. It's classic rabbit and hare, sort of a tortoise and the hare, I beg your pardon, sort of tale.
Absolutely, and to your point around that, sitting with the money in cash and then looking at markets. My favorite kind of country for doing proper research is the Americans, and they look at this and they say, well, over the last 100 years, in every market scenario you can think of over that 100-year period, what happens to investors who've put their money, phased their money into the stock market compared to those that have had the money in cash. And it could be in the middle of a crash, it could be the end of a crash, anything, any scenario. In all instances, if you say out of every 100 scenarios there are where you could invest, in only 2 out of 100 is it better for investors to have been in cash and sat on the sidelines compared to those who just put their money in a phasing in strategy and looking at what happens over the subsequent decade. So over 100 years of market history, you take every single day out of that 100-year history, and those are the thousands and thousands and thousands of scenarios that they're working on. And really, 2 out of 100 times you're better off in cash, which tells me those are awful odds. You're probably, to kind of say half the time, half the time would be a reasonable set of odds, but 2 out of 100. It just tells me that phasing in is almost always a better strategy than sitting in purely in cash. There are people who would argue, the mathematicians would argue that actually what you should do is always just invest your lump sums in one shot and don't worry about the market volatility. Unfortunately, there are many more times where that strategy could actually hurt you and cause a permanent loss of capital. And so to me, I want the best of all worlds, which is, listen to Mr. Buffett and don't lose money. And in other words, phase in. And if you miss out on some extra growth, that's okay. But losing money on a permanent basis to me is never okay. And so I'm happy to kind of be the tortoise in this. I'll gladly wear that as a crown, in fact, and be proud about it. I'm going to be the tortoise, but I am going to get to my 10,000 meter goal. And I'm not in a race with anybody else except myself.
Warren Ingram is a financial advisor. He is a director at Galileo Capital, talking tortoise and hare strategies this evening, and good, valuable, and not that common sense, frankly, because there's nothing common about common sense, but some good advice from Warren this evening. Then we got an email, Warren, from Libby Richardson, who is a third-year civil engineering student at Stellenbosch University, and Libby has a growing interest in investments. Now, Libby has a great question for us. She wants to invest in a company company, just one, with a very strong focus on sustainability or renewable energy. And she's wondering if you've got any advice, because pinpointing such a company on the JSE list of companies doesn't seem like a productive way of going about it. So I'm going to make that your problem. Answering Libby Richardson's question, third-year civil engineering student from Stellenbosch University. We'll get to that question with Warren Ingram in a moment.
The Money Show.
Personal Finance with Warren Ingram.
So, I suppose it's logical to suggest that any company that doesn't focus on being sustainable is therefore unsustainable, therefore you shouldn't invest in it, Warren. I mean, is that too simple an argument to make in this very big and complicated and quite messy debate around what is and is not sustainable?
Yeah, it is a very nuanced issue because, for example, let's just talk about a massive oil company that makes most of its money from drilling fossil fuels. If a company like that, at the moment will be one of the biggest polluters and one of the biggest sort of destructors of the environment, if they decide to turn their attention to becoming an energy company as opposed to a pure fossil fuel company, and then, more importantly, say we're going to, on a scale, on a real big scale, start providing renewable energy to our customers. They've got the history of being able to move energy from deep underground, into your car or into your house or whatever the deal is. They understand big business in a big way. And if a company like that decides to move, 30% of its energy to renewable energies, and over time, goes to 50, 60, 70, then to me that they have a very good argument for attracting sustainable investment money, because the reality is that they can really move the needle. They can really change the world. Whereas if it was you and me, Bruce, in our garage, and we decide we're going to start a renewable energy company, on no scale, and just see what we can do, we might be pure and completely clean from day one, but we might not have any impact on anybody outside of our own houses, and potentially upsetting our wives because we've messed up the garage. And so the reality is, I think that we can't be too purist in a world like this. We've got to say, are there companies making meaningful impact on reducing, whether it's the environmental issues, whether it's the inequality, whether it's racial inequality, governance issues, all of those. There are so many big issues around sustainable investing that I think it is a massively complex field. And
I think your question. Sorry, I think your main point is there is no perfection. There is no pure play of a company that takes oxygen and hydrogen and turns it into the purest, cleanest water in the world, or an oxygen purification company, or a company that just plants by hand, reseeds the Amazon rainforest. Those sorts of investment opportunities I don't think exist.
And if they do, they're probably very small businesses that that are starting out, and then we've got to change hats and say, if your job as an investor is to grow your money as well, then you don't have to do it to the destruction of the world. I mean, I think that's a terrible way to do things. But at the same time, you need to focus on creating sustainable financial positions as well, and that's where the world unfortunately is murky. And so I think that an element of pragmatism in this is critical, but that doesn't mean that we allow greenwashing, for example, as well, or where companies just tick some boxes on a spreadsheet to say no we comply, because that's also wrong. And I think unfortunately that's what happened here. Many years ago there were sort of these green ETFs and green investments, and they were awful. So to give Libby a kind of a clear point, I think there are some big index providers now, that have built a proper. The phrase, Libby, is ESG, environmental, social, and governance investments, and you can buy an exchange traded fund in South Africa. If you just look for ESG exchange traded funds, you'll find a choice now. And the work that's being done by these index providers is good. It's not perfect, as we said, but certainly you can start to allocate your money to these exchange traded funds with a fairly good, clear conscience that you are helping, and at the same time, I think the next decade, 2 or 3, you'll actually see that, these will outperform the more traditional indices and the more old world companies that don't adapt to how the world is and needs to move. So I think ESG is a great theme. I think it's a great investment theme just as a standalone thing. But actually, more importantly, it is the way we need to allocate our money to force businesses to change and move in the right direction.
Fabulous. Thank you, Warren. And then we need a phrase of the week. And this phrase, I'm not too sure whether it is on the top of my list or second on my list. I'm still getting over my hatred of the term innovation because it just got so badly abused and misappropriated and utilized in the wrong way. This phrase is Fourth Industrial Revolution. It is a figment of the imagination of the World Economic Forum. It's a wonderful way of describing a future, perhaps, that is going to be, artificial intelligence driven and the way in which it's going to work. But my goodness me, it's been horribly abused.
It has been, and of course, financial services companies are never slow to sell you a fashion, and I think that's what we're seeing here. There are companies that are selling Fourth Industrial Revolution funds as if they're going to be the answer to all investment problems as well. And so, just briefly, the term Fourth Industrial Revolution, it's basically where technology in its broadest sense, whether it's medical technology, artificial intelligence, all forms of technology intersect with the kind of the physical human world. The most basic example I can think of is, none of us, kind of carry map books anymore. We carry, maps on our phones and we tell the phone where we want to go and we listen to it, faithfully, in my case, until it takes us to where we need to be. And that's a form of where technology and my human requirements intersect. So it can be a big game changer. But again, from an investment point of view, to be early on a theme like that is not necessarily the way to make money. I'm happy to be a fast follower when I look at these trends. And I think we've got a real example with these vaccines. The biotechnology involved in creating the Pfizer or the Moderna vaccines are real examples of how this is changing our lives already in a very rapid and very real way. But be careful that that you think that all of these are just going to be great investments. Unfortunately, sometimes there are only 1 or 2 of these that actually come out of this as high quality investment opportunities for individuals as well.
Warren Ingram, Galileo Capital. Thank you, Warren. He is our regular commentator on everything to do with personal finance. Libby, I hope you're not too disappointed with the response, but that's the reality of the world in which we're living at the moment. Thank you, Warren.